Morgan Stanley's crash warning that a global recession is coming. I'm your host, Steven Van Metre, and thanks for joining me today. And first it was Bank of America calling for a crash. Now it's Morgan Stanley. Let's check this out, where Morgan Stanley warns ingredients for a global recession are on the table, and markets need to confront the possibility of an economic downturn. With inflation at the highest level in 40 years and the Federal Reserve taking increasingly aggressive action to cool consumer demand and prices, the risk of a global recession is on the rise, according to Morgan Stanley's economists. In a Monday analyst note, the bank's strategist, led by Seth Carpenter, said they have dramatically reduced their global growth outlook over the past 3 months as inflationary pressures have climbed and fears of a global recession have grown. We live in a most chaotic, hard to predict macroeconomic times in decades. The ingredients for a global recession are on the table. But is it really hard to predict? With the Fed entering a tightening cycle, well, historical probability suggests we are going to head in recession, if nothing else. But without fiscal and monetary stimulus to aid the economy, it's hard to believe that this is a hard prediction to make. Let's continue on, because still a recession is not the base outlook for Morgan Stanley strategists, who noted that a business investment and consumer spending remained strong in the first 3 months of the year, something we're going to challenge going forward here. In order for there to be a global recession, the economists said there needed to be a scenario where all energy imports from Russia, including natural gas, are cut off abruptly. And it seems hard to believe, at least on the front of Russia, that they are the linchpin to the global economy and that they can make or break a global recession. It seems to me in the past they had really nothing to do with prior global recessions. So how can the economy be this strong that they can trigger the whole thing? Well, I don't think so, but let's continue on. And while the Fed is taking action to tame inflation by raising interest rates at the fastest pace in decades, Morgan Stanley economists predicted the policymakers would reverse course at the first sign of doing too much. But as we covered in yesterday's show, Powell shows no signs because he's going full Volcker that he is going to bring inflation down. And with it running at 8.3% year over year and his target at 2%, it's got a long ways to come down. And any pain associated with that means he's going to keep going until he gets his desired result. And when we look back at what Volcker did, he triggered 2 recessions. So meaning we've got at least one coming. And if we're lucky, that'll be it. Higher rates and falling growth are never good for valuations. Avoiding recession is our base case, but markets will have to confront the rising probability of one regardless. And as we know, higher rates ultimately lead to lower rates during periods of falling growth, making that the bullish story for bonds. As Powell has acknowledged, there could be some pain associated with reducing inflation and curbing demand, but push back against the notion of an impending recession, identifying the labor market and strong consumer spending as bright spots in the economy. And we're going to look at consumer spending here shortly. It's a strong economy, he said. Nothing about it suggests it's close or vulnerable to a recession. Well, Morgan Stanley, we're going to challenge that whole view. But before we do that, one of your other analysts say, well, they're not as bullish as those are. Morgan Stanley's Wilson sees S&P 500 losses after bear rally. S&P 500 still not priced for earnings as macro slowdown, sees a technical support close to 3,400. With valuations now more attractive, equity markets so oversold and rates potentially stabilizing below 3, stocks appear to have begun another material bear market rally. And after that, remain confident that lower prices are still ahead. Now, bear market rally is when everybody piles into a dip in the market or a big pullback like we're seeing now, under the belief that the central bank is going to back off whatever it's doing much quicker than expected. And so everyone piles in, and that causes a big surge in stocks, or it tends to. So right now, you hear people that are very bearish on the market, but from a risk-taking standpoint, they have no fear. They're piling in and buying stocks, hoping to grab that bear market rally. But so far, with the liquidity drain, there's no sign of one at all. The S&P 500 surged on Friday after nearly a 20% drop from peak as market participants were lured by more attractive valuations. But the benchmark still marked its 6th straight week in the red, the longest such decline since 2011, as investors worry about a combination of surging inflation and hawkish central banks will spark a sharp slowdown. Although his base case doesn't foresee a recession, Wilson notes that the risk of recession has gone up materially, and that is just another reason why equity risk premium is too low and stocks are overpriced in our view. And so you see the other side of the story is people just don't believe a recession is in the cards. Well, we've got some charts we'll take a look at here shortly. Wilson expects the S&P 500 could slump as low as 3,400 points, about 16% below current levels, which is where both valuation and technical support are, he said. He expects the benchmark to climb to 3,900 by next spring, while saying the equity market volatility will continue. Of course, we discussed that in yesterday's show. The volatility is coming and back in a big way. Now, down here in this purple line is where Bank of America had their price targets. Here's Morgan Stanley's at 3,400 on the S&P. And here we see it's just over 4,000 now. Now, if you're concerned at all about what a 16% drop from here could mean to your portfolio, well, you shouldn't be. Be sure to check out Portfolio Shield. I'll put a link up here in the corner and the description below. Now, let's challenge Morgan Stanley's view that the economy is humming along and going to look great over the next couple quarters, particularly as quantitative tightening is going to start here in a couple weeks, and following that, another likely 50 basis point hike by the Fed. But the good news that Morgan Stanley will look at today is U.S. retail sales grew 0.9% in April, but how long will that last? As retail sales aren't adjusted for inflation, that means that while consumers have continued to spend more, they're likely getting less due to rapidly rising prices. In April, consumers spent more at bars, restaurants, vehicles, furniture, clothing, and electronics. However, they pulled back spending at grocery stores on home improvement and sporting goods. Receipts at gas stations also dropped, which is a surprise because everybody's bullish on energy as pump prices pulled back briefly. Gasoline prices have again risen, hitting record highs this month, and a great way to cure demand is higher prices. Consumer spending adjusted for inflation and seasonality accelerated in the first quarter compared to the last year, according to the Commerce Department, and it is a driving force of the economy. Still, there are signs that inflation is having an impact on retail businesses, as I'm about to show you. Now, Walmart said Tuesday that sales grew during the most recent quarter, while higher product, supply chain, and employee costs ate into profits. And we're going to hear more of that in the future. Inflation created more pressure than the company expected on margins, particularly in food and fuel. And let's take a look at a couple of charts I've got for you, challenging, again, Morgan Stanley's view that we're not likely to hit a recession. So what we've got here is average weekly earnings of all employees, and then I've subtracted off the consumer price index, both on a year-over-year rate of change, to give us an idea where inflation-adjusted earnings are for most employees. And here you can see that in blue, and then I've got advanced retail sales in red. And the reason is advanced, if you're ever wondering, is because it is heavily revised in the months that follow. And so it is an advanced picture of what they expect it to be. Here you can see in blue, going into the great financial crisis, that weekly earnings adjusted for inflation went negative. Now keep in mind, look at where they're going now. They're going negative. And look what happened with retail sales growth. It slowed, and then contracted. What's happening now? It's slowing, and guess where it's headed? Against, of course, the fact that wages just aren't keeping up with inflation. And so if your wages aren't keeping up with inflation, you can't spend more. And that's the real key here. And I think what a lot of people are missing. But that's not the only chart that matters when it comes to retail sales. Now we'll take the same retail sales in red on a year-over-year rate change and overlay the Wilshire 5000, the total U.S. equity market, on a year-over-year rate change. And notice here, going into the dot-com bubble, as stock prices go down, retail sales slow. Why is that? Wealth effect. Very clear wealth effect. Now, looking at the great financial crisis, we see a stock market year-over-year rate change collapsing, and that brings retail sales into a contraction as well. Again, the wealth effect. And you can notice here, stock market coming down. Where do you think retail sales are going? Well, they'll go down slower, but you know they're headed much lower as the equity market does. Now let's take some look here at some perhaps bullish news for bonds. Maybe not, because a lot of people have said that Japan has been selling. Well, they have been, but perhaps there's also some people that are buying. Let's take a look here at the major forward holders of Treasury securities. Data came out yesterday for the month of March 2022. We see that Japan sold $74 billion. Again, these are major forward holders of Treasury securities, $74 billion. And China at $15 billion. The total decline between February and March, $97 billion in Treasury securities. But here's what's really interesting. Out of that total number, which is about $7.6 trillion, we see there is, of which included in their foreign official, and that is about $4 trillion. And notably, between February and March, foreign officials, think central banks, sold $99 billion worth of treasuries. And of course, why do we know? What have we learned from our friend Jeff Snyder of what that means? Well, it means there's a dollar shortage, something we know that when the dollar goes up in value. But does that mean that just because foreign officials are selling, that that's the end, that means rates are going to continue to go up? Or are there other people buying? Well, let's dig deeper into the report. And here we have from the Treasury Department, the international capital data for March, and taking into account transactions in both foreign and U.S. securities, net foreign purchases of long-term securities were $23.1 billion. Now, obviously, that wasn't enough to offset, but there are people out there buying at higher rates, and that is what normally happens. Is a beginning after including adjustments such as estimates for unrecorded principal payments to foreigners on U.S. asset-backed securities. Overall net foreign purchases of long-term securities are estimated to be $1.8 billion in March. Foreign residents decreased their holding of T-bills by $16 billion, but foreign resident holdings of all dollar-denominated short-term U.S. securities and other custody liabilities increased by $12 billion. So we're definitely seeing some selling pressure there, but we're also seeing the beginnings of people stepping in and buying, and that tends to what happens when prices get low enough. So as we can see, that Morgan Stanley is calling for a crash, but no recession. Well, the question is, if they think 3,600 is target on the S&P, perhaps without a recession, how low may it go when there is one? I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.